The spread between the S&P 500's market cap weighted performance and its equal weighted counterpart has reached a divergence level not seen since the 1990s dot-com peak, signaling that a mere 5 tickers are holding up the entire global equity facade. While the headline indices hover near record highs, the VIX term structure has flipped into a precautionary backwardation, suggesting that institutional desks are paying a massive premium for immediate downside protection. Good morning and welcome to the CFO Suite Global Intelligence Briefing. The stability we see on the surface is an illusion maintained by passive flows into the Mag 7, but the underlying plumbing of the market is screaming liquidity trap. When we look at the current market structure, the concentration of liquidity in passive vehicles like the SPY and QQQ has created a dangerous monoculture. These algorithmic engines are programmed to buy the winners and sell the losers, but they lack a circuit breaker for a systemic correlation spike. We are currently tracking a sharp widening in high-yield credit spreads, specifically in the CCC-rated corporate bond sector, which has historically served as a 48-hour lead indicator for a volatility explosion. Furthermore, the breakdown in the S&P 500's breadth is staggering. While the headline index suggests a bull market, more than 40% of individual stocks within the index are trading below their 200-day moving averages. This internal rot is being masked by the massive market caps of Nvidia, Microsoft, and Apple. If we see a single disappointing capex guidance from the hyperscalers or a hawkish surprise from the Fed's latest dot plot, the exit door will prove far too small for the $1 trillion in trend-following CTA capital that is currently positioned long and leveraged. The danger isn't just a standard correction, it is a liquidity-driven gap down where bid-ask spreads on even the most liquid ETFs could vanish in minutes. We are seeing early warning signs in the Treasury market, where the MOVE index, the VIX equivalent for bonds, remains stubbornly elevated despite the equities rally. This suggests that the smart money in fixed income is already bracing for a violent repricing of risk. If this level of institutional analysis is giving you an edge in these volatile conditions, hit that like button and subscribe. We deliver this caliber of intelligence every single day to keep you ahead of the curve. To understand the catalyst for a potential flash crash, you have to follow the yen carry trade and the sudden shifts in global central bank liquidity. As the Bank of Japan edges toward normalization, the cheap capital that fueled global margin expansion is evaporating. This creates a margin call dynamic that forces the sale of the most liquid assets, tech stocks, to cover losses elsewhere. When the selling starts, the high-frequency trading algorithms that provide 90% of today's intraday liquidity will likely pull their quotes, leading to a vacuum. We saw this in May 2010 and again in August 2015. The current technical setup, with the S&P 500 trading at a 21 times forward earnings multiple amidst declining manufacturing PMI data, is even more fragile. Our proprietary market alerts model is currently flagging a red zone for systemic fragility. The risk is not a slow grind lower, but a vertical drop that triggers automated stop-loss orders across the retail and institutional landscape simultaneously. We are advising a shift toward long volatility positions and an increase in cash reserves to 40% for those looking to tacticalize a potential dislocation. The verdict is clear. The disparity between price and internal strength has reached a breaking point. We are maintaining an 85% confidence score on a significant bearish liquidity event within the next 30 trading days. For more institutional-grade financial intelligence and to track these volatility metrics in real time, be sure to subscribe and visit thecfosuite.ai. This analysis is powered by the CFO Suite. This content is for informational purposes only and should not be considered financial advice. Always consult a qualified financial advisor before making investment decisions.